A while ago, I just bought some Bitcoin. When I was going to my undergrad at Cornell University, a lot of folks were playing around with Bitcoin in the computer lab, computer science computer labs there. So,
what year was that?
2011, 2012. Really early days.
Okay.
So a lot of folks were experimenting with it, and just got a first exposure to it back then, and then bought some a little later down the road, 2016ish, and then more recently got into crypto full time, 2017, around the peak kind of ICO bubble.
Mm-hmm.
There weren't many people at all.
Yeah.
It was literally just a little fad that came along.
Mm-hmm.
After a while, it had a little price spike, 2013ish, and then after that, it was died down. And so it was in the back of my mind. But then when it really started to pick up action again, 2017, a lot of the folks around us, when I was in London, were focusing on price bots and momentum trading setups, where as soon as price is moving, they're looking. The focus is on price, and no one was really looking at the ledger, the actual blockchain. And so, that's why we founded Token Analyst. We decided, why not just look at the ledger itself to see what kind of information we can get from it.
So when you got into it in 2011, did you get into it just because you thought it was a cool experiment, or you liked the idea or the ideology? Or were you like somehow fighting for decentralized currency? Or
not really. I wasn't really fighting.
Okay.
It was just a cool experiment. People were playing around with it on the computers. You have to do a lot of, it was all terminal based to configure the private keys and so on and so forth. And then it was essentially just a number on a screen. And so it's hard to fathom the real life value of that number on the screen later on down the road of a virtual currency type of thing. So as I was saying, we started with the idea of looking at the actual blockchain, looking at the ledger, seeing what type of information we can get from it. And primarily this is around 2017, when a lot of ICOs and token projects were raising a lot of money, and so we started with the objective of tracking what they were doing with that money that they'd raised. So we started running Ethereum nodes initially and parsing the data from Ethereum, essentially from then on out, it started kind of a virtuous cycle. Okay, what kind of data can we get? Wow, this is really interesting data. Now then we can start to cluster this data, especially wallet data, into distinct entities to see what types of, so this belongs to this particular token project. This is their treasury, this is their developers, so on and so forth, and then tracing how they're using that money. So they send their money to an exchange, they're essentially liquidating that money, so it's not being used for the token project potentially, so on and so forth. So that's how we started.
So where did you start? How did you start thinking about it? Did you think, oh, this would be useful for someone in particular, or did you think, I just want to know more about how people are spending their crypto?
It was a lot about. It was primarily focused on kind of retail investors who were investing in these ICO projects and trading these tokens to bring more transparency. How is the project actually using this money, and how do these funds move around on chain, and how does that impact the markets? So there wasn't a direct correlation initially between, and people didn't make that link between what happens on chain and what happens on the markets. But slowly, as we started to expose more and more of these metrics, especially now over the past year, the flows into exchanges, because price discovery happens on exchanges, that's when things have started to pick up.
So no one was focused on this kind of metric approach to on-chain data. I guess it's kind of classical finance. Finance is interested in data and like looking at price movements of a commodity that way and stuff.
Yeah, there's that price movement part which a lot of folks are looking at already, but not people weren't looking at the kind of fundamentals, right? In finance, it's like a 10K for a company, or a balance sheet, and so on and so forth, and that's like the fundamentals of a company, like its earnings report, how much has it earned in a quarter. There's no fundamentals for Bitcoin except potentially the network stats, the actual blockchain stats. How many people are, what's the on-chain volume, what's the on-chain transaction count, unique addresses, so on and so forth. So starting with that, then building on into more sophisticated metrics.
Okay, so tracking the flow of this pipeline, basically.
Essentially.
Okay.
And what are the metrics that are actually useful and valuable? It was called the centralization ratio. So essentially, what percentage of a token's supply is held by a small group of people. So how centralized is this token? So essentially, so we saw token teams where 50% of the supply was held by the token team, and so when they moved the funds, essentially they could liquidate it completely and move the whole market. So it was a huge aspect to be aware of.
Okay, and you gave each token a rating.
Exactly.
Okay, and who came out on top? Do you remember what Bitcoin was?
We weren't doing Bitcoin back then. It was just Ethereum and all the tokens on it. And then eventually got to Bitcoin. So Bitcoin only came a little later for our journey, because eventually we realized most of these tokens were extremely centralized. They had very little activity on chain. People weren't using them. If anything, they were using them within an exchange. So no one was actually using the token for what it was intended to be used for. And so after a while, we realized it's only the top 2-3 assets are actually being used: ETH and Bitcoin.
How centralized was ETH at the time?
Not that it got dramatically more decentralized throughout 2017 as more people got exposure to it.
Okay, so it's become more decentralized.
It was, and then became more centralized again when the price.
Okay.
Yeah. Well, essentially, there was a small group of rich holders who initially had ETH and who knew about ETH in 2015. And then when the price shot up, they start selling it and dispersing it to a more broader base. And when price started dipping again, that broader base sold back to this core group. It may not have been the same core group that now holds it, but there's still a core group that kind of holds a lot of the ETH. In the early days, centralization was probably the peak one.
And so did people? Do you think people started using that to predict price patterns, or did anyone ask you for that, or find it really useful? Retail traders.
Early on, it was about almost choosing which tokens to invest in, because the choices were wide, right? It's like a grocery shelf where, what do I pick? Should I pick Decentraland or OMG or Status, or which of these tokens do I buy? Let's look at their centralization score, let's look at their on-chain volume, let's compare some of these metrics to differentiate, because they all look the same in aggregate. They have their individual quirks. So that was then, and then it moved more towards, now it's congregating around these top 2 or 3 assets: Bitcoin, ETH, Litecoin, and so how are these assets going to move? Rather than picking which asset to buy, it's only 3 or 4 now. How are they going to move?
Okay, right. So what came after that?
Well, after that, it branched out into this whole branch of fundamental metrics. So on-chain volumes, transaction counts, unique addresses, supply, UTXO stats, and then this year, 2019, this past year, we really started classifying wallets at scale. So what type of entity they are. So specifically exchange wallets, because that's where a lot of the action was happening. So we built some scripts to essentially automatically tag which wallets belong to each exchange. And then we can see the flow of Bitcoin and ETH into and out of these exchange wallets. And now that's kind of one of our most popular metrics.
Okay. What is it called exactly?
Exchange inflows and outflows.
Exchange inflows and outflows, and that's the problem on the retailers.
We get retail traders where, if you typically when you have an inflow of Bitcoin, this weekend we had a huge inflow of Bitcoin into Binance, and immediately after the price crashed, as you may have seen, 9,200 to 8,600 right now, and vice versa. When you see a huge inflow of stable coins, Tether, specifically into an exchange, we see buying action happen on exchanges because they exchange a tether for Bitcoin. And so it's essentially that relationship we've seen play out plenty of times.
Okay, so that's interesting. The relationship between almost a metric between tether, like stablecoins, and crypto, normal crypto, I guess.
Yeah, absolutely.
And how those things play out. So I guess traders have, what's interesting for me is traders have always gamified metrics. For example, one thing that I come across maybe is GitHub commitments, right? So a token, when people assess a token, one thing they'll look at is GitHub commitments. And some projects I've heard are told to break down their GitHub commitments so it looks like they're making more GitHub commitments than they actually are. So I guess it was someone using the metric of GitHub commitments
to optimize that.
Yeah, and then they realized, oh wait, someone's looking at it that way, so we need to
do X to optimize.
Yeah. I guess that's quite common in the financial world, and the metric game has to keep changing. I guess it's still early days for that kind more. Have you seen any other movements like that?
Well, the other gamification metric is volumes on exchanges, which is one I'm sure you've heard of, where a lot of fake volume that's on exchanges. A token team gets a deal with an exchange and they essentially manufacture the appearance of volume of that token on that exchange when it's not really there. The real volume is not really there.
How do you manufacture that volume?
Well, the exchange just fakes it.
Oh, they fake it?
And they display fake volumes, yeah. And so you think there's a lot of trading going on, then you start trading, and then you get caught.
Even the major exchanges?
No, not really major exchanges, smaller exchanges, and then it starts to spread from there on out. And so there's small volume here, then let me introduce volume in some of these bigger exchanges. So I think that's been a gamified. It's very hard to do the gamification on chain because you have to pay fees, and there's no authority you can go to. You can't call up an exchange and say, hey, can you help me out? You just have to actually do it, and so you have to pay a lot of money to fake on chain.
Yeah.
We have a lot of metrics. I mean,
your major ones that are interesting retailers.
The major ones: exchange inflows and outflows, miner flows to exchanges. We have tagged over 154 different mining entities, so mining pools and miners.
To exchanges, what was that?
Yeah, and then how they send the money to exchanges. So because miners to exchanges is a constant source of sell pressure in the markets. Because with every block they're earning Bitcoin, they need to sell that Bitcoin to sustain their electricity costs for the mining machines. And so we track that and see when they're selling more or less than they should be, or they usually do. And then on a more macro level, we track the UTXO metrics for Bitcoin. So whenever old Bitcoin is being moved, that's a huge source of insight where older players have realized that this is a price target that has been reached. I'm going to move my Bitcoin and sell it. And so
that's super interesting. Like old age uncertain UTXO. Okay. Have you calculated in terms of like 1 year old, 2 year old, 3 year old?
Yeah, exactly.
And you classified it as
into kind of bands. Like 1 day old and 10 days old, and then like moving on from 2 to 3 years, 3 to 5 years, and then greater than 10 years. Several bands.
Wow. Okay.
And then when a band moves, someone in a band moves, then it's interesting, especially the 3 to 5 years and the greater than 10 years. That's like really interesting stuff where, okay, you've been holding Bitcoin since 2016, you're moving it now, something's happening, that you feel is significant, Quite a bit. I mean, so essentially we have the fastest kind of Bitcoin WebSocket in the world. So a WebSocket is essentially a means of streaming data in real time. So we run a lot of nodes, blockchain nodes in our architecture and all over the world. And so we have exposure to the mempool, which is essentially
the what?
It's called the mempool.
Mempool, okay.
So as soon as you send me a Bitcoin, it's broadcast to the mempool of a node somewhere in London.
Okay.
And then that node eventually includes it in a block and puts it on the blockchain. And the miner that's mining the block will say, okay, this node has submitted this transaction. Okay, it's valid. Let me include it in my block, and I'll mine it on the blockchain. So there's the first stage is that mempool, which is essentially the cloud of transactions that have been emitted from all over the regional surrounding of the node, which is then broadcast from node to node in the peer-to-peer network. So as soon as stuff hits our mempool of our nodes, we know about it. So for example, you have like a huge influx of a token into an exchange. As soon as it hits the mempool of one of our nodes, we know about it.
So you know about it quicker than...
Way quicker than anyone else. Before it's even included in a block. And then it's included in a block. And then it needs 2-3 confirmations before it can actually spend it on the exchange.
Okay. So how long an advantage do you get, do you think?
Sometimes as many as 6 hours.
Okay.
Before it actually hits the market.
Okay, that seems like a useful one to have.
Very useful, very useful, especially in a pump and dump scenario when you know the pump is scheduled, or even if you don't know it's scheduled, you can see it happening on chain.
Right.
And so then you know something big is going to happen. I think it's becoming more sophisticated because it's a smaller community now. It's more sophisticated community. People are more aware of how it works, and so they're using a wide variety of metric sources, and you've seen other metric sources come up all the time. From prices to order books to trade volumes to exchange volumes, on-chain data, so on and so forth. Retail investors, just a small segment. There's crypto hedge funds, there's crypto just general funds. There's
crypto hedge funds across the globe.
Across the globe.
Yeah.
All over Asia.
Any estimate or
of how many?
Yeah.
Maybe like 100, 200-ish.
Okay. And you've been approached by a few of them?
Yeah, quite a few. That's our main customer base right now.
Okay, a hedge fund.
Yeah, crypto funds. And because they're the ones who are institutionalized, it's their job to trade. Therefore, they need to get an awareness of what's happening on chain. And then kind of, research institutions who are providing research to larger banks and family offices who are kind of on the edges, dipping their toes in the water, just to get a sense of what's going on in the market. And then you have anywhere from exchanges to market makers to custodians to other participants in this ecosystem wanting to know about what's happening.
Okay, so like Reuters might be one of the...
Yeah, absolutely. Reuters, Morningstar, Bloomberg, Barclays, Citibank, a lot of the folks are all interested in knowing about it, but not actively trading. And then there's closer to the actively trading, the crypto hedge funds.
I guess you'll see maybe your graphs at one point in a Barclays Bank research file or something, maybe. Hopefully. I think there was already a few citations, but it's definitely growing. It's definitely growing. We were cited in a few law cases or data against Tether. So that was interesting for sure. Okay, cool. So how do you come up with new metrics?
Are
you always working on coming up with new metrics, or are you looking at are people coming to you with saying like, this is what I want to?
A lot of folks come to us with suggestions and ideas, and then at the same time we also look at our own metrics to get a sense of what's happening, and then where is the money flowing to. It's mainly around money flow right now, because that's what moves the markets. So for example, the person who put money into Binance this weekend, who is that person or people or entity? We're trying to figure that out as we speak right now. So is it a OTC desk? Is it a market maker? Is it another exchange? So on and so forth.
Who put $1 billion of?
It wasn't 1 billion, but like they put up quite a bit of Bitcoin, several hundred Bitcoin into Binance to start to sell pressure this weekend from 9,200 to 8,600.
Okay, and you can look at whether it's a group of people or one person.
And then what's the initiative of that entity? What's their motive? And then seeing, can we track this entity over time, and then other entities like it, and then we kind of evolve a new different.
Okay, and you did a similar thing before with Huobi.
Yeah, Huobi. We track every exchange. Within each exchange, we've classified into the client-facing wallets the router wallets, the hot wallets, the cold wallets. And so we saw some internal wallets of Huobi start transferring into a chain that led to a $1 billion transaction. And everyone was wondering, where did that come from? It came from a Huobi wallet. And so it wasn't directly from Huobi, but it was someone who had an account at Huobi. And
they used loads of different proxy wallets to...
Exactly, to funnel it through. And a lot of the Plus token, you've heard of the Plus token scam.
Yeah.
A lot of their deposits went into Huobi. So,
So how many proxies did they end up using to
it was like 6 or 7 hops, on chain,
Okay, 6 or so like from one to another to another.
Yeah.
That's quite a lot, I guess.
Quite a lot, yeah. I mean, you just do it automatically through a bot,
Wow, crazy.
Yeah. For sure, yeah. Monero, Zcash, it's tough, for sure. Yeah, it's definitely tougher than Bitcoin. I mean, that we see the majority of action around Bitcoin and ETH for now.
Yeah, and I guess that's the most interesting. No one's asked about Monero or Zcash. Right?
There are a couple of folks, but not as many as for Bitcoin. Maybe like 20, 25 in this space, kind of actively providing metrics, different types of metrics.
On-chain and off-chain.
On-chain and off-chain, so price, market data, order books, sentiment, and then on-chain data. Within on-chain data, a whole bunch of stuff, smart contract data, fundamentals, exchange flows like us, a lot of different types of data.
Are there a fewer on-chain data than off-chain?
Yeah, definitely fewer, because it's a more new field. It's not something you can just pick up and go.
So there's like 3 or 5?
Yeah, 3 or 4, yeah. It's just, us and a few others. The most interesting stuff, I mean, is really what's happening on the real-time level on-chain. Because that's something that people are not as adept at paying attention to, but I think we have a good advantage in. So a lot of, for example, what drives these DeFi protocols is the ability to have people liquidate others. And you have to do it on a pretty fast basis to kind of beat out the others. And so it's like a cat and mouse game where you have to really be on top of your game in terms of latency to liquidate other folks. So yeah, I mean, speed is a big thing, and then also going kind of deeper into entity analysis. So yeah.
That's interesting that, speed isn't, I guess like, in trades, in normal finance, trades used to happen over like minutes, then became seconds, and then became micro, nano, femto, and it's just...
It's gotten smaller. Crypto hasn't gone through that transition yet. Most exchanges take 3 confirmations before you can even trade. 2 to 3 confirmations, so a confirmation could be 14 seconds in Ethereum or 10 minutes in Bitcoin. And 10 minutes is like the average. Sometimes we've seen Bitcoin blocks that are 2 hours apart. It's not defined. So when you have that kind of time latency, then something you see on chain can be immediately predicted to what you're going to do on the market.
Okay, so there's the battle for speed as well within this space.
I think that's an upcoming trend that not many people are paying attention to.
Okay, and how do you get quicker at knowing?
You run more nodes. You have a greater look over the entire market at the mempool level. So as soon as a transaction anywhere across the world hits, you know first before anyone else. So if we have nodes in China, in Australia, in the west coast of the US, east coast, London, Africa, then any other continents, if someone broadcasts a transaction, one of those nodes are going to receive it first. Microseconds after which other nodes across the world will, because of the internet, but we'll know first, and because of that knowledge, we can then act on it.
So do you have a latency time at the moment? Or
it's hard to measure, or benchmark, because there's not many others even doing it, but yeah, I mean, we're talking pretty small.
Pretty small, okay. Seconds?
Yeah, less even so, yeah.
Okay, that's interesting. Okay, there's a battle for speed and trading as trading becomes more professionalized.
That's the biggest use case of crypto right now, is trading and speculation. And especially with the derivatives market. So whoever can have an edge there, speed is definitely a part of that edge. Well, there's like the basic metrics, which is like, who's holding it, what's the kind of, lending rates, and what are the price oracles feeding into the contracts, because it's all smart contracts. So you need an oracle, an external actor, to feed a market price into a smart contract. You have to really trust that external actor. So there's a latency issue there because it's not tied to a centralized exchange. And then you have because it's a lot of DeFi is lending and borrowing and margin trading, you require other players to act as the other sides of the market. And so, margin positions need to be liquidated by someone that's not a centralized entity. Like there's no BitMEX governing over DeFi, so you need independent folks to go ahead and liquidate folks. And so, incentivizing these actors to take action, it's like an interesting upcoming trend. And then we're seeing who are these actors, who are these folks that are engaging in these DeFi protocols, what's their incentive. It's very small right now, so we did an analysis. There's approximately around 10,000 people in the world who have ever interacted with any of these DeFi protocols, the large ones. So it's a pretty small community, just from looking at on-chain data. That's our estimate. All good. I mean, you guys know at tokenanalyst.io, that's the website.
Yeah.
Check it out.
Yeah.